So in this case here, this is called dishonored notes. For some of the notes that has past due, this is called dishonored notes. Basically, past due notes, past due accounts receivable, usually we call it bad debt accounts or uncollectibles. Past due notes, we call it dishonored notes, receivables. So this is an example here, assuming that this customer has a 6-month, this company has a 6-month note that has 10% interest rolling, $1,200 signed off to another customer. And now it defaults, meaning that this customer didn't pay this notes receivable principal plus interest after 3 months. So in this case here, a company has the right to convert these notes receivable also into accounts receivable. Okay, so meaning these two actually could be switched around if the company decide to do so. They can decide to write it off, turn the case into debt collection company, or they can decide to switch them around and also buy customers some time to pay back the money. Okay, so earlier the case was uncollectibles transferred into notes receivables. This is the other way around. Converting the notes that is due, $1,200 plus $60, all together into accounts receivable account. Okay, so it states that creditor can transfer notes receivable into accounts receivable and then bill the customer for this accounts receivable. So this again, if it turns into accounts receivable, it gives customer additional a month or a month and a half to pay back the money. So when it's being converted to accounts receivable, don't forget to consider interest. So usually the problem will directly tell you what is the time frame for the note earlier. If it was a half a year note in this case, then $1,200 time interest rate times half a year of interest period is the total interest amount. And you plus the principal amount, that will be the total amount that will be converted to accounts receivables. Okay, so for notes, companies can either sign off notes when they loan money to others, or they can also sell products to others by signing off notes receivables. Remember, the only difference is that the credit part, the first entry notes inception, credit part could be cash, or the credit part could be sales revenue. In some cases, they may want to convert accounts receivable into notes, then this credit part will be accounts receivables. Okay. Other cases, if notes also past due, they didn't collect it on time, they can also convert this into accounts receivables. So this is really the call for the company. They can decide to do this or decide just to continually pursue the money from customer, but they have an option to do this.